You're making $80,000 a year. Decent salary, right? You've been responsible. You've saved some money. You're ready to become a homeowner. So you open Zillow at midnight on a Tuesday, and every single house that doesn't look like it's actively falling apart costs at least $400,000. The kitchen has laminate countertops from 2003. The carpet is that specific shade of beige that screams, "We stopped caring in 1997. There's fake wood paneling in the basement, and the listing agent has the audacity to call it a starter home. Meanwhile, the bank says, "You're approved." Your real estate agent is smiling and nodding. Your parents keep asking when you're finally going to buy. So what's the problem? Here's the problem. You can't actually afford any of these houses. Not really. Not in any way that doesn't turn your life into a financial nightmare for the next decade. And the truly insane part, nobody in the process of selling you that house has any incentive to tell you this. My name is Nick. Before we start, quick disclaimer. I'm not a financial advisor. This isn't financial advice. This is educational content. You should always consult with qualified professionals before making major financial decisions. Now, today we're going to do something the real estate industry absolutely hates. We're going to calculate what house your salary actually buys you, not what the bank says you qualify for. What you can legitimately afford without spending the next 10 years eating ramen and praying your car doesn't break down. Let's start with some uncomfortable reality. The median household income in America right now is $83,730. Sounds pretty good, right? Solidly middle class. The kind of income where you should be able to afford a normal house in a normal neighborhood. Except, here's the thing. The median home price in America is around $415,000 according to most recent data. So we're asking people making $84,000 to somehow afford homes that cost 5 times their annual income. If that sounds completely insane to you, congratulations, you're paying attention. But everyone keeps telling you it's fine. The mortgage broker says you're approved. Some guy on YouTube is telling you to house hack your way to wealth. Your friend from college just bought a house, so clearly it's possible. What's your problem? Why can't you figure this out? The problem is that everyone is lying to you about what affordable actually means, and I'm going to show you exactly how the math works so you can stop feeling like you're the one who's failing at something that should be possible. There's this guideline in personal finance called the 28% rule. It says you shouldn't spend more than 28% of your gross monthly income on housing costs. That's your mortgage payment, property taxes, insurance, HOA fees, all of it, 28%. The banks have a different number. They'll approve you as long as your total debt to income ratio stays under 43%. That's housing plus car payments, student loans, credit cards, everything, 43% of your gross income. Now, here's what nobody tells you. And this is critical. There's a massive difference between what the bank will approve and what you can actually afford without destroying your life. The bank's job is to make sure the loan doesn't default immediately. That's it. They don't care if you're miserable. They don't care if you can't afford groceries. They care that you keep making the minimum payment every month for 30 years, that 43% threshold. That's not a recommendation for comfortable living. That's the maximum amount of financial stress they think you can handle before you just stop paying entirely. Let me show you what this actually looks like with real numbers, because this is where it gets brutal. Let's say you want to buy a $400,000 house. That's actually below the national median, so we're not even talking about an expensive home here. You scrape together a 10% down payment, which is $40,000. Congratulations, that probably took you 5 to 7 years to save. Now you've got a $360,000 loan. At current interest rates, around 6.09% as of February 2026, your monthly mortgage payment, just principal and interest, is about $2,150. But wait, we're not done. Not even close. Now add property taxes. Depending on where you live, you're looking at anywhere from $300 to $650 per month. Let's call it $450 to be conservative. Then there's homeowners insurance. Thanks to climate change making everything more expensive to insure, and we'll get into this later, you're probably paying $250 to $350 per month. We'll say $300. Oh, and because you didn't put 20% down, you've got PMI, private mortgage insurance. That's the fee you pay every month for the crime of not being wealthy enough. Add another $275. Then there's maintenance. The general rule is to budget 1% of your home's value per year. On a $400,000 house, that's $4,000 annually, or about $333 per month. And that's assuming nothing major breaks, which is adorable if you think that's how houses work. Add it all up. Your total monthly housing cost is now $3,508, not $2,150. $3,508. That's what actually owning this house costs. Now, if we follow the 28% rule, what income do you need to comfortably afford this? You need to be making about $150,000 per year. The bank, using their 43% threshold, would approve you with an income as low as $98,000. See the problem? There's a $52,000 gap between what the bank says you can afford and what you can actually afford without financial catastrophe. And here's the punchline. So only about 20% of American households make $150,000 or more, which means 80% of American households cannot comfortably afford a $400,000 house under any reasonable financial standard. But that's below the median home price. So we've created a housing market where the typical American home is unaffordable to the typical American household. This isn't an opinion. This is just math being cruel. Let me walk you through what this actually looks like in real life. A household making $80,000 combined, roughly the median, saves up 5% for a down payment on a $400,000 house. They get approved because their income just barely fits under the 43% debt to income threshold. They move in. They feel like they've made it. Here's what actually happens. Their total housing cost is $3,191 per month. That's 47.9% of their gross income, but after taxes, their $80,000 becomes about $4,667 per month take home. Their housing payment eats $3,191 of that, leaving $1,476 for everything else. Now, add utilities, groceries, car payment, insurance, gas, student loans, and health insurance premiums. That's $2,482 in monthly expenses before housing. They have $1,476. They're $1,006 short every single month before clothing, medical copays, entertainment, or savings. The bank said they could afford this house. The math says they absolutely cannot. Every unexpected expense becomes a crisis. The car needs brakes. That's $800 on a credit card. The HVAC dies. That's $5,000 finance. This is what being house poor means. You technically own a house, but you can't afford to live in it, maintain it, or enjoy it. Now let's talk about what actually makes a house comfortable, because this is important. A household earning $200,000 per year buys that same $500,000 house, but they put 20% down, eliminating the PMI. Monthly housing costs are about $3,770, which is just 22.6% of their gross income, well under the 28% guideline. After taxes, housing, all expenses, a $2,500 monthly retirement contribution, and putting $500 into an emergency fund, their budget balances. This is what comfortable looks like, and it requires being in the top 10% of American earners for a house that's only 20% above the national median. Think about that for a second. You need to be in the top 10% to comfortably afford a slightly above average house. Here's where it gets really interesting, that $500,000 buys you completely different realities depending on where you live. In San Francisco, $500,000 gets you a 600 square foot studio condo. You'll probably have roommates. The HOA fee will be $500 a month. You'll share a wall with someone who plays the drums at 2 a.m., In Los Angeles, you might get a one-bedroom in Koreatown, not Beverly Hills, not Santa Monica, Koreatown. In Austin, $500,000 creates a choice. You can have a downtown one-bedroom condo, or you can drive 20 minutes outside the city and get a brand new 5-bedroom house with a yard. In Atlanta, $500,000 gets you a 4-bedroom house in a good school district with hardwood floors and a 2-car garage. In Cleveland, $500,000 is straight up luxury. You're getting a 4,000 square foot historic home with a massive yard in one of the best neighborhoods. The income required to buy a median home in San Jose is $501,760. In Cleveland, it's $63,611. That's an 8 times difference within the same country. The housing market isn't broken uniformly. It's broken in completely different ways depending on your zip code, and this brings us to the part that makes this truly infuriating. Your parents bought a house at your age. They keep reminding you of this. What they're not telling you, because they don't understand it themselves, is that they bought a house in a completely different economic universe. In 1980, the median home price was about 3 times the median household income. Today, it's 5 times. Your parents were buying houses that cost 3 years of their salary. You're being asked to buy houses that cost 5 years of yours. But wait, you say, didn't they have crazy high interest rates? Yes. Mortgage rates in 1980 were around 13%, peaking at over 18% in 1981. Monthly payments were brutal. But here's the thing. The purchase price was reachable. They could actually save the down payment in a few years instead of a decade. And more importantly, when rates dropped, they could refinance. You can't refinance the purchase price. Also, and this is critical, college cost $738 per year in 1980. Your parents weren't graduating with $40,000 in student loans. The average new car payment in 1980 was about $153. Today, it's $748. They bought houses on single incomes because one parent staying home was financially viable. Today, you need 2 incomes just to qualify for the mortgage, and even then you're stretched. Baby boomers currently represent 42% of all home buyers, and half of them are paying cash. Meanwhile, first-time buyers have dropped to just 21% of purchases, a record low. The median age of a first-time buyer has risen from 28 in 1991 to 40 in 2025. Think about that. The average American is now 40 years old before they can afford to buy their first home, and increasingly they're doing it with help. 7% of first-time buyers now use an inheritance for their down payment. Family wealth is becoming a prerequisite for homeownership. Now let's talk about all the costs nobody mentions until after you've bought the house, because this is where the real pain starts. The mortgage payment is just the beginning. Recent studies show average hidden annual costs hit $21,400. That's $1,783 per month for maintenance, utilities, property taxes, insurance, and internet. And let me tell you, everything breaks. Water heaters die every 10 to 12 years. Replacement cost $600 to $2,500. Roofs fail every 20 to 25 years. That's $10,000 to $30,000. HVAC systems last 15 to 20 years. When yours dies in the middle of summer, you're looking at $5,000 to $12,500 for a replacement. And these aren't optional expenses. These are things that will happen. Then there's the fun surprise of homeowners insurance, which has become its own financial crisis. Insurance premiums have risen 48% nationally since 2020. In Florida, people are paying $5,800 to $15,000 per year for homeowners insurance. That's over $1,200 a month just for insurance. In Louisiana and Oklahoma, it's almost as bad. Climate change isn't some distant future problem. It's hitting your insurance bill right now, and it's only getting worse. Insurers are projecting another 8% annual increase through 2027. Property taxes are the other silent killer. New Jersey has the highest effective rate at 2.23%, which means $9,541 per year on a median priced home. Texas has no state income tax, but property taxes average 1.80%. On a $400,000 home, that's $7,200 per year or $600 per month. And these taxes go up every year, forever. Now, let's talk about the other debts that destroy your buying power, because this is where most people get blindsided. The average student loan payment is between $200 and $536 per month. The average car payment is $532. If you're one of the 20% of Americans with a car payment over $1,000, congratulations. You've essentially disqualified yourself from homeownership. Every $250 per month in debt payments reduces your mortgage qualification by about $40,000. So if you're making $120,000 per year, but you've got $400 in student loans and a $532 car payment, you've got a pre-mortgage debt-to-income ratio of over 11%. That means at the bank's 43% threshold, you only have about 32% of your income left for housing. You're looking at a maximum housing budget of around $3,200 per month, which qualifies you for maybe a $400,000 house. And remember, that's using the bank's number, not the comfortable number. And let's talk about actually saving the down payment, because that's where most people's dreams die quietly. A 20% down payment on a $415,000 home is $83,000. The median household saves about 5% of their gross income, which is roughly $4,000 per year. At that rate, saving $83,000 takes 21 years. Even if you're aggressively saving $1,000 per month, that's still 7 years. Meanwhile, housing prices are increasing 3 to 5% per year, so the target keeps moving. You're trying to catch a bus that's accelerating away from you. So what's actually going to happen in the housing market? Is there going to be a crash that makes everything affordable again? No, sorry, that's not happening. Every major forecaster, NAR, Zillow, Redfin, Fannie Mae, they're all projecting flat to modest growth of 0 to 4% in 2026. Mortgage rates are expected to end the year around 5.9%, maybe dipping to the high 5% range. That's good, it's better than 7%, but it's not the 3% pandemic rates that briefly made things more affordable. Here's why there won't be a crash. 81% of existing mortgage holders have rates below 6%, 21% have rates below 3%. These people are not selling, they're locked in. If they sell, they have to buy another house at current prices with a 6% mortgage, so they stay put. This means inventory stays low, and low inventory keeps prices elevated. It's a feedback loop, and there's no obvious way to break it. Inventory is improving slightly. We're up about 10% year over year, but we're still nearly 18% below pre-pandemic levels. Homes are sitting on the market a median of 66 days, up from 59 last year. Things are loosening, but slowly, not fast enough to help buyers in any meaningful way. And here's something truly depressing. Renting is cheaper than buying in all 50 of the largest US metros, every single one. The average mortgage payment exceeds average rent by 38% nationally. In San Francisco, buying costs 191% more than renting. If you're renting and feeling like you're throwing money away, you're actually making the mathematically rational choice in most markets right now. The typical break-even point where buying becomes cheaper than renting is 7 to 15 years in expensive cities. Most people don't stay in their first home that long. So where does this leave you? Let me be direct, because someone needs to tell you this. If you're making less than $140,000 a year and you're looking at a $500,000 house, you need to stop. Just stop. You're about to make a decision that will dominate your life for the next decade, and not in a good way. I don't care what the mortgage broker says. I don't care that your real estate agent keeps telling you this is normal. The math is the math, and the math says you cannot afford that house. You have options, but none of them involve buying a house you can't afford. Option 1, you move. I know, nobody wants to hear this, but if you're making $100,000 a year and trying to buy in San Francisco, you're fighting a battle you cannot win. That same $100,000 in Pittsburgh, Cleveland, or St. Louis buys you a very comfortable life and a house you can actually afford. About 20% of remote workers relocated in 2025 specifically because of cost of living. Geographic arbitrage is real. Option 2, you buy way less house than you think you need, If you can afford $300,000 comfortably, but everything in your market is $500,000, you accept a longer commute, a smaller house, or a less desirable neighborhood. You optimize for financial stability instead of impressing people. Option 3, you house hack. Buy a duplex, live in one unit, rent out the other. The rental income can cover 50 to 100% of your mortgage, or buy a single family home and rent out bedrooms. It's not glamorous, you'll have roommates, but your housing costs drop to nearly zero while you build equity. Option 4, you wait, you keep renting, you save aggressively, and you wait for your income to increase or for the market to shift in your favor. This might take years, that's okay. There is no prize for buying a house you can't afford. There's no trophy for being house poor. Here's what I need you to understand. You are not failing at homeownership. The system is failing you. Home prices have outpaced wage growth so dramatically that what was normal and achievable for previous generations is now a luxury item for most people. A $500,000 house is not a starter home. It's not affordable on median income. It's not something you should stretch for unless you genuinely have the income to support it without financial acrobatics. The real question isn't whether you can technically qualify for a mortgage. The real question is whether owning that house will actually improve your life, or just transfer your money to a bank while you stress about property taxes and hope nothing breaks. The math is screaming at you. The bank is whispering that you're approved. The real estate agent is smiling. Your parents are asking when you're finally going to buy. But you have permission to look at the numbers, run the real calculation, and decide that it doesn't make sense. Not right now. Not at these prices. Not with your current income. And that's not failure. That's math. That's reality. That's making a decision based on what will actually make your life better instead of what everyone else thinks you should do. Your salary buys you a lot less house than you think it does, and understanding that might be the most valuable financial lesson you learn.